Okay, now we're ready.
Now we're good? All right.
Aaron's so punctual. He's like,
I am. I'm like, boom.
Like, dude, get your crap together, man.
It's all good. All right. Can you hear us now? Every good? Just put it there in the chat that you can hear us nice and clear. All right. Thanks, Stacy. All right. Very good. All right, Gopi, thanks for joining us. All right, so here's what we're going to do as Matt's getting the slides ready. This will be recorded. We are doing it live here in our office out of Phoenix, but we'll have it recorded. It'll be up on our website under the podcast and webinar section, so you'll be able to access it there. And basically every 10 or 15 minutes, we'll kind of take a little break during the presentation, and we'll do some live Q&A, and then we'll wrap it up with live Q&A as well. Please type your questions into the Q&A box. Let's not use the chat box. That's just there when I need to do audio video checks, and we will use the Q&A. Awesome. Okay.
All right. Well, let's get this show on the road. Thanks everyone for being here this is our third Directed IRA webinar. Maybe. So we do these monthly. You can access them at directedira.com. There'll be recordings up there. As Aaron mentioned, you'll get a notification when this recording goes up, which will probably be in a day or two if you got to jump off. But we have some slides and materials. We'll get you copies of those too, so you can get those on the website. There'll be a link for those to get the slides after the presentation as well. All right. Well, before we get into this, I just want to say this is the bread and butter of self-directed retirement accounts. We're buying a rental property. And I think this is probably the most common asset. Someone has an account at Directed IRA. We're setting up a lot of crypto accounts right now. That's hot now. That could be the future. But we have a ton of real estate accounts, lots of clients doing this every day. And so we just want to break down the rules, let you know what's possible, let you know some of the structures that are common. Can I partner with someone? Can I get a loan? Can I use this account to do this? How can I manage the property? What can I and can't I do? We're gonna hit all those topics through this. So by the end, the goal is if you thought about buying a rental property in your IRA, by the time you've watched this webinar, you'll be like, I know what I need. I know what I need to know. And I know where if I have questions, where to go to get them. So
love it.
Okay, well, let me go hit some slides here. We're going to toggle back and forth this to see, Aaron's beautiful face. And, I'm not,
You're not too shabby.
Yeah, I'm trying. I got a haircut yesterday, so
looking good.
I was like, I got a webinar tomorrow. I better get my haircut. So, okay. Well, okay, now, as many of you may know, I am an attorney too. So this is attorney Matt talking right now. This is not legal advice. This is not financial advice. We're trying to provide educational information for you so you know what to be doing, where to check, and who to talk to. So this does not constitute an attorney-client relationship. Seek out your licensed professional. Okay, so a little bit about me. I'm the CEO here at Directed IRA. Aaron's the COO. I'm also a partner in KQS Lawyers. I have the Self-Directed IRA Summit, which I host every year, which we just did 2 or 3 weeks ago, which was 2 days of self-directed content, and it is recorded and available now if you want to buy it.
It's awesome. Yeah, that was a great 2 days too.
It was cool. So if you're like, man, I need to learn more about self-directed IRAs, that's the kit and caboodle, so to speak. Do you know what a kit and caboodle is?
I do now. Okay. I'm still in the kit and caboodle.
Okay, I think it's like a makeup thing, isn't it? Like makeup, like a caboodle, so. Like you put like your makeup in.
I think so.
I have a teenage daughter and 2.
We got a bunch of daughters between the 2 of us.
Yeah.
3 and 4. Like we got 7 daughters between the 2 of us.
Yeah. So, yeah.
A lot of kit and caboodles.
Yeah, we've been through a lot of kit and caboodles. But the self-directed IRA kit and caboodle is the summit. You can go to SDRA Summit. You can find it on my website, sdrahandbook.com too. So I wrote the #1 book in the space on self-directed IRAs. It sold 30,000 copies. It's $20. It's right here. I've had some people tell me this is the Bible and they have it on their nightstand. That was a little weird description. But other people just said it's been a great book and helped me self-direct my IRA. I'm like, okay, that's what I was going for. I wasn't trying to compete with the Bible. Jeez. Okay. All right. Well, let's take a step back. I think some people you may have zero in a retirement account. Like someone watching this might be like, I have $5,000 in an IRA, or I put $6,000 in for this year, Matt. Like, how am I going to buy a rental property? Well, I want you to think about rental properties, and there's other things you can do in real estate that are not for today. There's stuff in the summit. We got a lot of other resources, but I just want to really focus on the rental property owned by your IRA. If you think about it, there's 30 reasons why people are interested in this topic and why I think you should know about this. There's really 30 trillion reasons, okay? I say this a lot in my presentations. There's $30 trillion in retirement accounts. I don't know why, but I feel like I got to remind everyone, this is where all the money's at. This is where your money's at. Many of you have a little sliver of this 30 trillion. You've got your own few hundred grand, or maybe it's 50 or whatever it is, millions. I've got clients with tens and hundreds of millions in IRAs. It's crazy. We've also got people that have 50,000, 100,000, 5,000 self-directed in their accounts. There's a broad spectrum, but whatever sliver of this 30 trillion you've got, you can learn how to buy assets and trust. Okay, you're not just stuck to the stock market to buy stocks, bonds, and mutual funds. You can buy rental real estate. You can buy the duplex down the street. You can invest in a private fund that owns a little apartment building. You can do an Airbnb rental. You can buy a vacation rental. You can flip a property. You can buy Bitcoin or Ethereum. You can invest in a startup. Okay, these are all things that our clients are doing with self-directed accounts. And so we're going to focus on the rental today. It's the vanilla. It's not sexy, but it's tried and true. Okay, we're just going to focus on that today. So now, if you have no money, you're like, man, I got zero. I don't even have a sliver of that 30 trillion. Well, that's where everyone else's money's at. If you're in the real estate industry and you're like, well, I do real estate deals. I want to know how I can fund my next deal. Ooh, I'm flipping or rehabbing a property. I need 100 grand to rehab this thing. Where do you think the money's at? It's not in your friend or your rich uncle's savings account. It's probably in their retirement account. Like if you think of the average American out there right now, their investable cash is in retirement accounts. So to fund deals, particularly smaller or mid-sized deals, retirement accounts are one of the #1 funding sources to get that done. So knowing these rules helps you be a more savvy investor in your personal real estate business and investing, not to mention just your own retirement account at the point you get there. So just think of this as a valuable tool that you can use in real estate in general.
It's like, that's why I love, your book is such a great resource, because my father, retired, worked for the government for 30 plus years, had a pretty large 401k, and he really knew nothing about self-directing. Went and read the book and he's like, oh, great, I can do real estate with this, because he wanted some rental property, had a piece of property in his real name, but had way more money in his 401k than he did personally. And so this was great.
Yeah, and I think a lot of people have trust in real estate. Many people are diversifying out of the market, to get some more tangible assets. We've seen real estate be on a run lately, of course, and the general markets have too, and the crypto markets and everything. But also I think real estate's a place where we've seen a lot of clients of ours that have big accounts have a strategic advantage. Okay, they've been like, well, I'm a real estate agent or broker, and a lot of times I speak, and I do classes for real estate professionals, and I'll ask them, like, who can tell me a good mutual fund here? Nobody raises their hand in the whole audience. How many of you own a mutual fund? Half of them that raise their hand, they have a mutual fund. Okay, who can tell me a good real estate investment? Everybody's hand goes up. They know a property they think would be a good real estate investment buy. But what are they investing their money in? Mutual funds. I'm like, well, why are you guys buying mutual funds if you're in the real estate business? It's like LeBron James going to play ping pong, like, what are you doing? Go play what you're good at. And if you're going to bet money on it, especially, go do what you're good at. So invest in what you know. That's one of the tenets of self-directed retirement accounts. Okay. All right. I was just trying to hype you guys up a little bit. Forgive me, but
some people like the hype, some don't.
Some people are like, dude, get on with it.
I know.
Yeah,
we got a little flavor for everybody, though.
Okay, I've heard your spiel. Just get on with it. Okay. Let's just think about retirement accounts in general. I'm going to get into real estate and the technical stuff here in a minute, but I just want to make sure everybody's on the same page on why the heck retirement accounts matter. Okay, if I buy Facebook stock in my IRA for 100 grand, and then I sell that Facebook stock for 150,000, I need a $50,000 gain. that 150,000 goes back into my retirement account, right? But I don't have to pay any tax. Okay. Well, that's awesome. That's one of the perks of retirement accounts in general. When you're making money, you don't got to pay the IRS or the state. That money just stays all invested, and you just go on your next deal and next deal and grow and grow and grow. And for traditional accounts, it comes out tax deferred, and you only pay tax when you pull the money out of retirement. And then Roth accounts grow and grow and grow, and you get to pull it out entirely tax-free on the way out at retirement. Now, real estate works the same way. If I bought a property for $100,000 and I sell it for $150,000, that $50,000 gain is not taxable. Okay, it goes back. The $150,000 goes back in the IRA, and I can go buy something else. I could go buy crypto, or I could buy the next rental, or I could flip a property. I could do a private loan. Okay, it's not like a 1031 exchange in real estate where you got to rebuy within a certain amount of time and all this. So the same tax perk I get when I buy stock or mutual funds and I make money on them in my retirement account, you get that for real estate. Okay. The other thing from a big picture on retirement accounts is this is where all the money's at. And in particular, this is where a lot of large accounts have gone. The Government Accountability Office, which I helped them on 2 reports that they did on retirement accounts in general. One of them was on mega IRAs that were $5 million accounts or larger. One thing they found on that, the finding in there was, these accounts are mostly self-directed IRAs. It's like, well, what are the smart people doing? What are the people that have large accounts doing? I think it's kind of interesting when they talk about retirement accounts, how we need to reform retirement accounts. The one thing they don't talk about is like, what are the successful people doing that have large retirement accounts? How have they got a large retirement account? Nobody freaking talks about that, okay? And it's because people that are investing what they know, they're taking control of it. Now, sure, you might want to be a more conservative person. You're like, man, I don't even understand real estate. Okay, learn it first and then invest in it. But if you're a real estate person, or you're learning about it and you feel good about the real estate market, this is just a really cool tool. All right, now this is the point when this is, I feel like this is the conversation we're having here, each of us, where people start to ask, well, Matt, I called Fidelity where I have my IRA, and I said I want to buy the duplex down the street. Fidelity said, you can't do that. Well, that's not because IRAs can't own real estate. That's because IRAs at Fidelity can't own real estate unless you're an ultra high net worth person with a 50 million relationship or higher. So for most people, if your IRA is at a Fidelity or a Vanguard or a Schwab or TD, all those institutions, they're broker dealers. They sell financial products. They want you to buy what they sell. Doing a real estate deal for them is a pain in the ass. They don't want to do it. Well, that's what we do. We love that stuff. And there's other providers of IRAs that do too. Now, what you'll need to do is you'll need to move your account from your existing broker-dealer IRA or bank or brokerage that typically wants you to buy financial products like stocks, bonds, or mutual funds. And you'll need to move it to a custodian like us, like Directed IRA, who allows you to invest and self-direct. And what self-directing basically means in a self-directed IRA is it's a retirement account that can invest in any asset allowed by law. So if you want to buy real estate here, great. You want to make it a rental, awesome. You want to flip it, cool. You want to buy crypto, great. You want to buy a privately held company, awesome. You want to invest in an LLC or a small business, great. Okay. We're not going to limit your menu to just stocks, bonds, and mutual funds. You can do those here. I mean, people don't really come here to do that here, but like you can if you want. We've got the menu in terms of these common self-directed assets like real estate and like the rental property we're going to get in. So I don't know if you want to go over, Aaron, the 3 different ways people can get money over here. Probably like the common ones. This here kind of, the slide we're showing now talks about the different ways you can get money into the IRA. And get it really to like a self-directed custodian, like directed IRA.
Yeah, so I guess one of the common misconceptions that we get a lot internally is, let's just use the Fidelity as an example.
Yeah.
Okay, that's where I got my, I got a traditional IRA, a tax-deferred IRA over there. You don't have to do a full transfer out or full liquidation. Yeah. We get that a lot, and that's a big misconception. Like, most of the people don't. But at first you think you have to. You don't have to do that at all. Let's say you got $500,000 over at your Fidelity account, and you got this, duplex maybe in the Midwest, and it's going to run like $350,000. Well, you just do a partial transfer out, and it's called a cash transfer, It's a one-page form, super easy to do. You fill out your basic information, and we send it over to Fidelity on your behalf, requesting the $350,000, and they're going to wire, Fidelity's going to wire the funds over to your IRA account. Let's say it's a directed IRA, that'd be cool. The next thing is, like, you may have an old employer plan. So like my dad, he had an old employer plan over at Boeing, and it was just his old 401k. And he had, and then he had another 401k at Raytheon, and he just kept them there. So they were invested, one at Fidelity, one at Vanguard, but they're considered these old employer plans or your old 401k. What you have to do in that scenario is you have to reach out to the HR department or that sponsor of that plan, and that information will be on your statement that you're getting. And so you'll reach out to them and tell them you want to move some money over to a self-directed IRA, and they're going to give you a form to fill out, and you're going to do the same thing. Typically, just a partial transfer out or maybe a full.
Yeah, and those are called a direct rollover.
Yep.
So when it's your old employer plan, or maybe it's an employer you still work at and your retirement plan age, you're over 59 and a half, so you can pull the money out. That's called a direct rollover. Just the lingo here.
Yeah, so we'll get so these are some good industry terms. So like I'll try and simplify it a little bit, but yeah, this is the term for that. And then the other one coming over from Fidelity, directly where you have an IRA already over there and it's not an old employer plan, that's a trustee to trustee transfer. And you want to hit on the 60-day rollover?
Yeah, so the last thing you can do, which we don't love, you can only do one of these every 12 months. It's called a 60-day rollover. So sometimes we'll see that. It's like, well, I just took a distribution, but I have 60 days to get it back into an IRA. Let's say I had an IRA at my bank and I was like, just give me my money. I didn't want to have them send it directly to you. Well, you've got 60 days to redeposit it into an IRA, or it's considered distributed. So now the most common is just do a trustee to trustee transfer. If you're already in an IRA and you want a self-directed IRA, let's say it's a traditional IRA, you just go traditional IRA from your broker dealer, traditional IRA at directed IRA. If you're a Roth IRA, you're going to go Roth IRA at your broker dealer to Roth IRA at directed IRA. If you got the old employer 401k that's traditional dollars, it's going to go into a traditional IRA at directed IRA. Now we do health savings accounts. You can self-direct Coverdell's, backdoor Roths. Solo 401ks.
HSAs.
HSAs. We do all those types of accounts. You can self-direct here. So, but the common ones are going to be the Roth and traditional IRAs. That's 80% of the market, and so those are the ones we're going to be seeing most. So, all right. Okay. So the first step is you got to get the self-directed IRA. The second step is you got to get it funded. So you got to move the money over from your current plan, whether it's an old 401k or whether it's an existing IRA. Now you've got your money here. Okay. Now we're ready to go. And it's important to say this because that is the first step. You do not buy real estate in your personal name and put it in your IRA. A lot of people, they start the process like, all right, I want to buy property in my IRA. And they start a contract in the name of Aaron Halderman. And then it's like, or Aaron Halderman LLC or whatever your LLC is called. And then they just think, well, I'll just assign it to my IRA at closing.
No big deal, right?
Yeah, no big deal. I found the deal. I'll use my IRA and I'll get that set up later.
Yeah.
Okay. Problem. There's a rule called the prohibited transaction rules that restricts you from moving assets or contracts or properties between yourself and your IRA. So you're stuck there. You're not going to be able to do that. If you did that, you have to start a new contract and start it over. Have the IRA be the purchaser on the contract from the beginning, or an IRA LLC, which we'll get to here in a minute. So what I want to do here is, at this point, we're just going to go through an example of a deal. This is one of the rental properties I bought in my retirement account, my traditional account, and I did it in 2017. I used a non-recourse loan. We're going to talk about that. I'm just going to give you the numbers on the deal that I did. And that is actually the real picture of there. I've got a great landscaper. I like that green grass.
That's is that in Indy?
This is the one in Indianapolis.
Okay.
Yeah.
We can't get grass like that here, can we?
Yeah, that's rare. You can see that in Phoenix. So this is the pride of the Midwest is this property here. So this has been a great rental on my account. I think it's helpful to just show a real actual example and talk through it so you can see the issues. Okay, so here's the numbers on. I'll come back to this as we go through the example, but I just want to hit some preliminary points. Now, again, these slides, there is some text and content in these.
Mm-hmm.
Watch out for the recording. It's going to be posted on our website too. You'll be able to download these slides. So the first conceptual point I said at the beginning is, remember, you're not buying the property. If Aaron's wanting to do this with his IRA, Aaron Halderman is not on the contract. Aaron Halderman is not on the deed. Aaron Halderman does not pay for the earnest money deposit, okay? Aaron Halderman's IRA does. So it's going to be directed trust company, FBO, Aaron Halderman IRA. That's what's going to be the purchaser on the contract, all right? Who's going to pay the earnest money? His IRA. He's going to instruct us to say, hey guys, I'm buying the property here on 123 Green Street. The contract will be in the name of the IRA. He's going to instruct us to send the deposit to the title or broker, all right? And then we're going to pay that out of his IRA. Now, when it goes to close on the property, the IRA is going to send him the money to close. All right. Now, when the property sells or there's rental income, that goes to the IRA. When there's expenses on the property, the IRA pays it. Right. So you're not involved here in terms of the money. This is not you. Remember, it's your IRA. So everything's circling through with your IRA. Now, what are some of the common problems people have when they're managing the property? Like, what are things that you shouldn't be doing? Your IRA ends up buying a property. And we're going to get into how to use a mortgage. It's possible to do that. We'll go ahead and get into that. But what do you think some of the things people should be aware of?
Well, like, don't go do any of the work, maintenance yourself. We get asked that all the time.
Yeah.
You know, can I just like go fix it up, or can I be my own handyman, or, you know, can I manage the property myself too? Is another thing that comes up.
Yeah. And let's say that, like, on managing the property. So
because that's a little nuance.
Yeah, that's a nuance. That's the best word for it. Like, you can't put on the tool belt and fix up the property.
Right.
We're not okay with that. That's probably going to cause a prohibited transaction and violate IRA rules. But you can show the tenant the property, show a contractor what needs to be fixed, you know, make sure things are happening on the property and it's being taken care of. Clients are always like, well, Matt, what happens if like the toilet's leaking in the middle of the night and the house is going to flood and I can't get a plumber there? Do I need to stand there and wait for it to destroy my property?
Sure.
No, like, you know, turn the water off or do whatever you need to do.
I got to call my IRA custodian on Monday.
I can't do anything. I have to wait for a property manager to show up. You know, insurance company, here's my major claim, you know. So what you can't really do is like add value to the property physically, like by doing physical work. But you could, you know, draft the lease, make sure the tenant's paying their payments, you know, talk to them if there's an issue. That's okay. Many people hire a property manager though to do it. Like in my example that I showed just a minute ago, this property back, you know, my Indianapolis property here, like, I don't go to that property. Okay. Yeah. I don't fix it. I have a property manager that handles it, that also gets it leased as I've had a tenant turnover since I've had it, which is fine. That happens. And they're also going to follow up with the tenant as well to make sure payment's happening. So the property manager is getting the money, paying the expenses, and saying the cash flow to my account. And I'm going to show you, I used an LLC in this example. So we'll break that in here in a moment. All right.
This is cool because we do have some questions of people coming in about, you know, well, I need the income, you know, off that property. So really then we got to get into a few different, you know, areas about the qualifications and, you know, distributions and stuff. But a lot of people ask that all the time. They want to get in the retirement account, but they're like, oh, I also need some of that income from it.
Well, let's take a step back. When your IRA is buying mutual funds and stock, were you taking the dividends your stock got, or when you sold the stock and made money, were you taking that out?
In your retirement account.
In your retirement account. No, it's building up for retirement. Remember, this is not a I live off this money today account. This is a building wealth. It's a retirement account. It gets all these tax preferences because you're growing it for that magical age of 59 and a half when the government lets you take it out without any penalties. Now, if you are 59 and a half, you're golden. Don't worry. Take the cash flow out right when it comes in. You can pull money out of your retirement account whenever you want once you hit 59 and a half. But for everyone else that's below that, we're not doing this strategy to build wealth that you can spend today. Retirement accounts are a long-term wealth building strategy so you can fund and have a comfortable retirement. All right. So think of this, think of your retirement again for the long haul. This is a long-term strategy.
I love it.
It's a good question.
That was a good one.
Okay, any other questions you feel we should hit?
Well, I just wanted to bring it back into context and kind of close the loop on the funding of the account, because I probably got 5 or 6 questions on that. So one of the big ones is, well, can I still move 100% of my IRA over at Fidelity, for instance, to a self-directed one? The answer is yes. You can do that. Others were, well, what if my IRA is invested in stocks?
Yeah.
You know, currently, well, what do I got to do to get that now into my self-directed IRA account?
Sell, baby, sell.
That's it.
Sell it all.
Yeah.
Yeah, you want to get into a cash position, and then you transfer over the cash to directed IRA or another self-directed custodian if you're, you know.
Exactly.
But don't do that. Don't do that. Okay. All right. Any other questions, or should I?
No, let's hit on this. We'll come back to the other ones that are a little bit further in the presentation.
Okay.
Yeah.
All right. Let's talk about getting a mortgage. Okay. Now, it is possible for your IRA to buy property and kind of be the down payment money and to get a loan for the balance. But for those in the real estate or people who didn't buy your own house or you buy rentals, you know, in your personal name, the rules are different.
Mm-hmm.
Okay. With a retirement account, you cannot guarantee the loan. The IRA cannot guarantee the loan. Your typical mortgage document is not going to work. What you'll need to do is use a lender who allows for non-recourse loans. We have a list here we'll show you. It's on our website too, of many of the ones that are common that our clients use and some that I've used personally. And so these lenders have what's called a non-recourse loan. And the non-recourse loan says basically, we're going to loan your IRA money to buy a rental. But if you default, we're just going to force the property to be foreclosed to get our loan paid back. We're not going after you, IRA owner. We're not going after your retirement account for any deficiency. We're just going to foreclose and take whatever money we're owed out of the property. Okay. Now, because those loans are like that, where they're non-recourse, the bank's going to require 30 to 40% down. All right. They're not going to let you put down 5%, 10%, even 20%. Right. They need to make sure that the retirement account's got enough skin in the game and there's enough equity that if there is a non-recourse, or sorry, there is a default later, they'll be able to get their loan paid back by foreclosing and taking the property.
I'm seeing a lot of those. They've even ratcheted up more to like 40 to 50% now.
Yeah.
Even, especially like with the craziness of the market right now. They're like, you need to have more skin in the game.
Yeah, I've seen 40 to be common. Actually, the one I did was at 40%.
Yeah.
I know that the larger the property and the more money you have in, I've seen that ratchet down. So if you're buying, you know, also I've seen like condos and other properties like that having, you know, being more on the 40 to 50 instead of 30 to 40. So, and there's different markets, you know, so there's different banks you can check. Those are 4 there. You know, we've had customers use in the past, and I've used 2 of those myself on deals. So, but here, just know, this is not like the mortgage you're going to go with your typical mortgage broker.
Yeah.
Even for you experienced real estate investors, there are private lenders we run into. There's a big private lender that works with a lot of our accounts that are buying rentals that are kind of teed up, and they kind of lend on specific properties that come through a pipeline. So
like they're managing their own fund.
Right.
You know, that's specific to doing this type of, you know, loan.
Yeah. So there's kind of different little pieces of the market, but I think in general, what people need to know is if I'm getting a loan, it's got to be non-recourse. You know, now a lot of people, it's more common on the real estate side that people just buy the property outright with cash. I don't know that's the best use of money. You know, sometimes it's like, well, why don't you just buy 3 rentals instead of buying 1 with cash? You know, you could use that cash to just buy 3 or 2, you know, rather than just buying 1 outright with cash. But some people just like having all the cash invested. They don't want to worry about debt. They don't want a bank in the way. And with the last real estate crash, I get it. There's a lot of people who just kind of change their tune on that. So, but if you are going to get debt, don't guarantee it.
Well, the other thing too is I know a lot of you listening in, because I kind of look at the stats and stuff. You know, you're in like kind of some more affluent areas or cities. You know, you're maybe in the Bay Area, or you're in Austin, which is like just a booming deal, and it's hard to find anything for less than $500-600K. So you're probably going to have to get a non-recourse loan if you want to buy a rental property.
Yeah, in your home market.
Yes, in your backyard.
Yeah.
If that's where you want to stick to, absolutely.
Yeah.
But this, like your deal, is great because it was an indie.
Yeah, like even in 2017, I was like, I'm not buying more rentals in Phoenix. Hell no. You know, the Phoenix rental market, I mean, it's got good appreciation. You know, maybe that was a dumb move, but so is this one. And so I've gone to where I chased cash flow. That was my primary concern on when I was buying at least this one. So let's look at this one. So this one was 85. I ended up putting 40 grand down. I didn't have to put that much down, but it's kind of what I had in there at the time to work with. And so I was like, I'll just throw 40 down. So I ended up getting a non-recourse loan for 45. And at the time when I bought the property, the monthly rental income was $950. Now this is another issue. If you're doing a non-recourse loan, one of the requirements is it must be an income producing property. They're not going to loan you money on raw land. Okay. This needs to be an income producing property. And it could be single family, multifamily, you know, and you could use a non-recourse loans with LLCs with a bunch of retirement accounts partnered into an LLC that buys a little apartment building. You know, some of these lenders will do those loans too.
What about a development, a new development?
A new development, no, because I mean, you're gonna need a private lender on that, or you'll want to, there's specialty lenders, and some of those non-recourse lenders might do that, but that's not an out of the box loan product they sell, you know, for IRAs. So what a lot of these banks are doing non-recourse loans, they got a little loan package in the box that they just, you fit these requirements, they approve your loan. Because they're not pulling your credit. I mean, they might pull your credit, make sure you don't have judgments, but it's not like you have to have a certain credit score or income. That has nothing to do with the loan qualification here. They're qualifying the property. Do we think that the property is worth what we're lending on it? Does the rental income cover the mortgage payments that need to be made? That's what they're focusing on.
Are you putting enough down?
From
the IRA.
Does the IRA have enough skin in the game? So
it is 85,000, just so you know. Yes, we missed the zero, but we'll fix that. Matt bought the property. His IRA bought the property for 85,000.
Oh, I didn't know.
Not the 85.
Yeah, dang it. Yeah, 45,000 and 40,000 equals 85. Okay, so I did that in 2017. Now, right now, that property rents for $1,200 a month. Now, my mortgage is $405 a month. That includes, because it's only a $40,000 mortgage. It's a 25-year term, but that includes my taxes and insurance. I do have a property manager, so that's coming off the top at 10% for my $1,200 a month mortgage payment. So if you look at my cash flow at the end of the day, my annual cash flow is $8,100. That's on a $40,000 cash down investment. So it's an annual return on investment just on the rental income of 20%. Now, the other nice thing about this is, and this is the things of real estate, right? This is one of the things people love real estate.
Yeah.
You have cash flow and appreciation, right? Like a lot of people buy a stock and it's like, okay, the stock goes up in value and I get appreciation, but am I getting a dividend maybe? If I get a dividend, it's not like rental cash flow, not like this at least, or not like, and I've been chasing properties like this. There's others, but like, this was a good deal when I got it and it's been a good deal. That's why I'm showing it. But
not all sweetheart deals like that, are they?
Well, at first, this one was just pretty ordinary, I mean, the rental appreciation.
The real estate cycle.
Yeah, the real estate appreciation is not incredible. It's good on the rental income, but then the appreciation, has been great, and that's happened to on other properties that I have too. And I think anyone in the real estate space that was buying, back in that time frame, you've done well on your property. Mm-hmm. So. Again, that's why you may be interested in real estate in the first place, or that's maybe why you've been good at it. So, all right, so we've got the non-recourse loan. Now, there's one other piece you need to know, and Mark Kohler, Directed IRA CFO, co-founder, likes to call this the four-letter word. Okay, there's a tax called UBIT or UDFI, and I need to jump ahead. Nope, I didn't put it in there. Okay, let me summarize this. For today's presentation, we don't have enough time to dig too far into it. On the Directed IRA website, it's a whole chapter in my book, this issue, and I have a lot of resources, articles, webinars actually on this tax called UDFI, Unrelated Debt Financed Income. This is a tax basically, that applies to IRAs when they leverage the property with debt. Basically what the rule is it says, you know what, Matt, if you look at my example here, the IRS looks at this and says, you know what, you bought a property for $85,000, but almost half of that was debt. Mm-hmm. And so we're going to tax half the profits. So when you make $8,100 a month, or excuse me, a year in cash flow, that's your net income. Mm-hmm. Now I get to take depreciation expense against that, by the way. And eventually I can whittle that down so I don't need to worry about it. But just hang with me here for to understand the tax. After all my expenses, I take that $8,100 down. Let's say that I got depreciation and any other expenses. And let's say that that $8,100 now is $3,000, okay? Mm-hmm. The IRS is going to look at that and say, well, $3,000, half of that is a result of the debt. Mm-hmm. That was not IRA money, because half the money that you used to buy that was not retirement account money. It was debt. So we want to tax half the profits you make on this. And that tax is called UDFI. It's because you brought in debt. So on $3,000, half of that is $1,500. $1,500 would be subject to this tax. Now at that rate, by the way, you get a $1,000 deduction. So in that example, maybe I'm paying on $500. There's a $1,000 automatic deduction you get on the tax form for this. So it's pretty minimal in this example here. If you had a large property with a huge cash flow and a big percentage of debt, you could run into this tax. And we have lots of clients that do, and they just pay it. You know, I mean, it's like I could buy way more property and get way more income on it than I could by just buying a property with cash. So what do I care if I'm paying a little tax as a toll to do it? At the end of the day, I'm netting far more money. So, but you do need to know about it. It's called UDFI, unrelated debt finance income.
Where do they find the tax table for that?
In my book. Yep. If you try to find the UDFI or UBIT tax table, there's no such thing. It's the trust tax rate tax table, but it's in my book, and it's on. There's on the SRA handbook. If you just Google UDFI and UBIT, the tables are on there.
You'll get an article. You have an article.
Yeah, we have articles on the website. So. And also we have a podcast episode on it. So the Directed IRA podcast, we had a whole podcast episode on UBIT and UDFI that Mark and I did. So more content on that if you think you may run into it.
Any tax filings that need to happen when you go sell?
Okay, so if you have that tax, now let's say I sell the property. Let's say I sell it, you know, for right now I sell it for $170 and I got 50% still debt. And actually right now I got I paid my loan down to 30%. Yeah. Or to 30,000, because that's, you know, when I make my mortgage payments, I'm paying down the loan balance, and I actually pay a higher mortgage payment than I'm required because I'm trying to get rid of the loan. So, but let's say that my debt now is 30 grand. So let's say my leverage percent, because you take the debt versus against the purchase price to determine the leverage percent. So now I'm at what's 30,000 divided by 85. I mean, that's basically 1/3. Let's say 1/3, pretty close. So, and now I'm gonna have a gain there of 85,000 because I'm gonna sell for 170, bought it for 85. So I got a gain of, did I do that right? Yeah, 85. I got a gain of 85,000, okay? Now 1/3 of 85,000 is basically 30 grand. So if you follow the process there, you gotta determine the leverage percent, which is the purchase price you bought the property. It's called your basis, divided by the average debt when you sell. That gives you your leverage percent. And then then I got to determine what my gain is, which we're saying is 85 here if I sell it at 170. Now I take 1/3 of the, so 1/3 of this is debt, is the result of debt. So 1/3 of the,
about 5 grand.
Yeah. Well, so I got 30, so I got 1/3 of
85,000.
85 is like
30 grand.
30 grand.
Yeah,
okay.
28 and change.
Yeah, and then you pay tax at 20%. I get the capital gains tax rate, which is, would you say, so 20% on 30 grand.
Yeah, that's just 6 grand.
6 grand. Okay. Yeah. So if you didn't follow that there, sorry, there's a lot of math there. Some of you engineers may have you probably followed that and got my calculations corrected. But
they'll chat it to us in a minute.
Yeah, but what I want you to know is the principle. Don't worry about the calculation right now and the detail on it unless you're in this situation. And if you are, my book has a whole chapter on it. And of course, all the research on the website. There's a ton. I have so much free information. You don't need to. I mean, the book's just, if you want it all condensed in one place, that's $20. But like, there's so much free information.
You can just go to the easiest thing, and our staff here at Directed does it. You can just go to directedira.com and go to the Learning Center and just do a keyword search. You can literally type in UDFI, UBIT, you can pull up all the articles. It has it all there.
Yeah. Or any podcast episodes.
Yeah.
Like I said, we have the podcast episode on it. So
many
some that
materials.
have material on it. So, okay. All right. So we got the debt. Let's talk about some prohibited transactions.
Okay.
Okay. So these are things you can't do. Now, Aaron mentioned some of the early on, the common one is can't work on the property.
Mm-hmm.
Also, you can't live in the property yourself.
Mm-hmm.
Okay. This is an investment property. This is not a property that's like your second home. Your IRA is not buying something for you. You're restricted from using assets your IRA owns. So is your spouse and your kids and your parents. So here, this is the Government Accountability Office that did a report on self-directed IRAs and kind of realized some of the problems people face in holding things like real estate or other alternative assets, right? There's some of these things like they can't work on the property, right? We've talked about that. You can't rent it to a relative, okay? You can't do that. Don't pay for expenses personally. Remember, if the property tax bill comes for this property your IRA owns, you don't own the property. Your IRA does. Your IRA pays the property tax bill, all right? Your IRA pays if there's something that has to be fixed on it. You need a new AC unit. Your IRA is going to need to cover that, all right? Okay, now there's different varieties of prohibited transactions, and there's a lot of content we have on that. A whole podcast episode again. It's 4 chapters in my book. But the ones we've noted here are don't work on the property, don't use the property or have certain family like these family members here in red, your spouse. For those of you in Utah, that includes all your spouses. They're all restricted, okay? It's a Utah joke. Is that okay? Yeah. I'm from Utah.
You're from there, so
I'm from Utah, so
it's totally fine.
I use that joke in every presentation. Your kids, are restricted, the children of your kids, grandkids. Now, your siblings are okay. So your IRA could own a property and lease it to your sister. All right. Your IRA could own a property and actually lease it to your father-in-law. Okay. They're not restricted either. And your more distant family members are not restricted either. So they could have use of the property.
Could I pay a disqualified person to manage my property?
No, you could not. So, or what another common one is I'm a real estate agent.
Oh,
I want to buy the property and get the buyer's agent commission. How do you feel about that?
Yeah.
Do you like that one or no? No. Okay. You're making money.
I mean, I like it.
Yeah.
I like it. Yes, I like it. But it's no.
From a tax standpoint, the IRA rules
So I have a couple from anonymous attendee. Let me just jump in here real quick because it's all pertinent. Because it makes some good points, but let's break this down. So I can cut grass.
Can anonymous attendee just give us a cool fake name instead?
I know.
Anonymous attendee, since you got good questions, Aaron flagged them, but just a special request from me is just be like Peter Lemoncello.
Yeah.
Or give us a cool name.
Yeah, Mr. Burns, whatever.
Give us a cool name.
Sorry if there's actually Mr. Burns on here. So I can't cut the grass, unplug a toilet, but I can spend time and energy to find the property, get a property manager, hire the lawn service company, get a roofer.
Yeah. Is that a question or is that a frustration?
It's a question
because
and a frustration.
Welcome to the tax code.
Yeah.
There's so much stuff in there that's nonsense. It doesn't make sense. And on the services standpoint, what we basically came to the conclusion of is if it's administrative, managerial, or oversight, the IRS is not going after that stuff. They know you got to do that crap. But if you're physically improving or doing physical work,
adding value
to the property, they're going to have a problem with that because you're doing that in a way that the IRS doesn't get taxed. That they don't, like if you go upgrade the kitchen and add the $100,000 in value and it's in your Roth IRA and then you sell it, they're like, well, wait a second, that wasn't fair. You just add all this value into a tax-free asset and we didn't get paid.
Yeah.
So it's kind of just the nature of the way the tax rules work and also from how the IRS would try to enforce it or a tax court judge. And I think it's fair, quite honestly. I think that's a fair consideration. So yes, the line is a little nonsensical, but
let me hit on.
Write your congressman. That's all I can say.
Let me hit on this one before you jump back in there, because this is important too. We get it all the time. So can I pay my fees to set up and that checkbook IRA LLC, but can I also pay my property inspections and my property insurance with my personal credit card?
Okay.
This is key.
All right. How do I answer this? Let me say this. There are 3 exempt things that you can pay for your IRA that are in the tax code. Your account administration fees for your IRA. So your fees to directed IRA for your IRA, put on your credit card if you want. Send us a check, give us a debit card. It can all be personal money if you want. Or we can just charge your IRA from your IRA balance. That's okay. So account administration fees, managing your plan, that's all stuff you can pay for personally. The second thing that's exempt, accounting fees. If you're hiring an accountant to do a 990T or just to get general tax advice on how the IRA tax rules work, what you can and can't do, that's exempt. The third one that's exempt, legal fees, okay? Paying your lawyer. Maybe you're working with KQS Lawyers, our sister law firm, or maybe you're setting up an IRA LLC and a legal provider is setting that up. Those are legal fees, okay? Those 3 things are exempt in section 4975 of the tax code. So you can pay for those things personally, but that's it. Now, let's say the property tax bill, or what were the other ones that were the example?
Inspection.
Inspection, okay? You don't own that property.
Yeah.
That's an expense the IRA needs to bear. It's not an accounting expense. It's not an account administration expense, for your account custodian, and it's not a legal expense, all right? So that's stuff the IRA needs to pay. Now, let's say you did that. Okay, let's say that you bought property with your IRA, or you started buying it and you paid for the inspection.
And you didn't end up buying it.
Yeah, because
that's a great scenario.
Well, let's say either way. Let's say you're going to buy it or not. I mean, either way, you need to deal with this. So let's say that you did that. First of all, realized you did it wrong. And I get it. People get in the hurry. The agent's like, you need to pay the inspector. I need a credit card.
It's called deal heat.
Yeah. You're like, I just set up my IRA 2 days ago. I need an IRA LLC too. And we're going to get to that in a second. Here's my credit card. And you're like, okay, I did that. And then you call us and we're like, first of all, at Directed IRA, don't call with those questions.
Yeah.
Okay. It's not attorney-client privileged. If you call your IRA custodian, Directed IRA, or anyone else, and when I was advising clients as a lawyer, I'd say, do not call your custodian with these questions. I can't tell you how many people got referred to me from their IRA custodian, and back before I had my own company, and they'd say, yeah, this person called us and told us they had a privileged transaction. We told them we're going to distribute and close out their account because they told us what they did and asked us if that was okay. And can you write a letter and tell them that was okay and it's actually not privileged? If you can do that, we can save their account. If you can't, we're going to close it. I'm like, okay, what did they do? Yeah, I can't write a letter for that and close their account. What do you want me to do?
Yeah.
So realize your account custodian is not someone you go, I did this, was that okay?
Do not do that.
Do not do that. So go talk to your CPA or attorney, preferably an attorney because it's attorney-client privilege. And it does not need to be KQS lawyers. I'm not trying to sell legal services. Believe me, we're busy. We want to be helpful, but go whoever you can to get that advice. But let me teach you what you need to know. Okay. Having said that, I'm getting a little preachy.
This is good though, because we're getting a lot of stuff that needs to happen. You on the pulpit?
I feel like I'm being a little preachy. I'm sorry,
Let me hand you the mic.
I'm sorry, guys. I don't know what it is. I just feel a little preachy right now. Okay, let's go back to that example. You paid for an expense, let's say the inspection, buying a rental in your IRA. You paid for it personally. All right, and there's an exemption in the tax code in 4975, section D10. This is the Prohibited Transaction Code exemption section. Exemption number 10 says a disqualified person, which is you, the account owner, can be reimbursed for expenses actually incurred for the plan or here for its assets. So you can be reimbursed for that. So it's okay if you did it once. If you do that every month, it is not okay. I've had some clients be like, they did it once, and then they're like, oh, I'll just pay for this thing every month on a recurring thing on my personal credit card. And then I'll come to you at the end of the year every year and just be like, hey, I need to get reimbursed for this. I paid for it all personally from my IRA. No, that's not going to work. That's not what the exemption's built for. It's been built to fix one mistake. All right. It's kind of like you get You get like one mulligan on this. All right.
It's for those of you that like golf. Or
yeah.
Mainly
so,
golf.
Yeah. So maybe it's not even the 3 strikes for you baseball people.
Yeah.
Okay. I mean, it's possible, but I'm just saying, don't use it as a way to just pay for everything personally and have your IRA reimburse you. Okay. This is meant to fix a mistake. So it could be fixed and you can rely on that. We've had to do that for some clients over the years, of course, that have kind of messed it up. And it's like, how do I deal with this? Well, let's do a reimbursement. We'll rely on 4975 D10 and get you reimbursed back. Another thing is sometimes you can work it out at closing. If you paid for something personally, just pay for it again at closing from the IRA and go back to that company and say, hey, you got paid for this twice, reimburse me back here when I paid for you personally. Can you credit my card back that I paid for this personally?
Yeah.
So there's some other ways to fix it.
Okay, Stacy, one more and then let's roll into it.
We got the IRLC next too.
So yeah, because I got a bunch on those. So
Okay.
the insurance and utilities then need to be in the name of my IRA, correct?
Exactly. Yep.
So great question.
Yep. And on mine, like I'll just say, like I use State Farm. You know, it wasn't hard. I just got a State Farm agent, and for my property manager referral, I don't use State Farm personally, so they didn't have to mix up my personal stuff with it. They just did a landlord
Which
policy.
is probably a good strategy.
Yeah. I think the problem is some people they use the same insurance. They have their personal auto and their personal home.
Little.
Then it shows up on the same statement, and their agent's like, well, I can save you $2.25 if I put it on a combo policy here. And you're like, oh, great, let's do that. Okay, no. Like, are you going to cut 2 checks to pay the insurance? Don't get sucked into that.
Cool.
Okay.
I like that.
All right. Let's go to the IRA LLC.
So now we're going to hit on the structure. I know we got a lot of questions on that. So we're going to dive into the couple different structures here. So hang tight.
Yeah. So the first thing we talked about is IRA or retirement account. Again, this could be solo K, HSA, whatever, buying the property directly. Now, many real estate clients, particularly for rentals, and even me, I did this in my deal I showed you there. My account owned an LLC 100%, and the LLC bought the property. Okay. So rather than my IRA being on the contract to purchase and then sending my contract to directed IRA and then sending the earnest money and then sending the deposit, them signing the closing docs, them getting the rental income, they pay the mortgage expense. Now, again, you can have a property manager here in the middle to help alleviate that, but there could be a lot of back and forth.
A lot. Yeah.
And we still have, I mean, we do a deal a day if someone's buying real estate, at least, with right out of their IRA. We can do it. It's not hard, but it's a little bit more of a back and forth.
Now it's in the name of your IRA, right? Just to get this simple, it'd be like Directed Trust Company, FBO, Matt Sorensen, Roth IRA.
Yeah.
Like that's who owns the property.
Right. Now, a lot of real estate clients prefer instead to have their LLC own the property. And this is a special LLC that the IRA owns 100%. This is not your regular LLC you own. The IRA owns it 100%. The LLC in turn owns the property. Now you can be manager of this LLC and have a bank account with it. Okay. By having a bank account, the IRA is going to invest its money in the LLC. The LLC is going to have a checking account where that money is held. You're manager of the LLC. You'll be able to cut checks, send wires. You have a debit card that are used to buy the property, to cover expenses. Also, when you got income, that goes into the LLC bank account. Now, you never take money from the LLC. All right. You don't own the LLC. Your IRA does. Now the money can accumulate in the LLC bank account. Let's say all the cash flow is just accumulating there. You can do that. That's what mine's doing. I actually have a crypto wallet that my LLC owns, but when I have enough cash flow accumulate, I've been going and buying crypto. And if I have enough, I'm going to sell it and then go back and buy another property. Then when I don't know. So you can let the cash accumulate here. You can just let it sit in cash. You can send it back to your IRA if you want. If you want to take a distribution, you need to send it back to the IRA, and then you take a distribution from the IRA. So just remember, though, this LLC bank account, you do not pull money from it. You do not own it. Your IRA owns it. So you're the manager, and you got signing power, but do not take the money. Don't pay yourself a salary. There's a case of a guy named Ellis. There's a case called Ellis versus Commissioner. He had an IRA LLC structure like this. He was the manager. He was paying himself $30,000 a year to be the manager. Can't do that. Okay, you're benefiting, you're paying yourself from your IRA effectively. And so that was a prohibited transaction. He fought it in tax court, lost. He appealed it, went to the U.S. Court of Appeals, lost. Okay, you can't do it. We always told clients you couldn't do it even before that case. So, all right, so that's the basics of the IRA LLC. Now, the nice thing about this one, this is the most common IRA LLC. Your IRA owns it 100%. It's called a single member LLC or disregarded entity for tax purposes. What that means is the IRS is not looking for a tax return for this LLC. It's owned by one party, which is your IRA 100%, which does not file a tax return, okay?
That's a beautiful thing.
That's awesome. So all you got to do is you got to keep the LLC active with the state. So my LLC is actually, it's an Indiana LLC, all right? And because it's in Indiana, and it's actually an Arizona LLC because it does some other stuff that's also registered in Indiana. But so we generally will set up the IRA LLC in the state you own the property, okay? So, but you got to keep that LLC active with the state. And yes, in California, you've got to pay the $800 annual fee.
Yeah. Don't try and get around that.
Yeah. Don't do the IRA trust or business trust in California.
Yeah.
It doesn't work. We don't allow it here unless an attorney writes an opinion letter and stands by it, which no one's taking us up on it. Okay. Let me just
make this last comment before you get into the multi-member. If you have any reason to believe you might be doing something, you're like, I don't know if I should be doing this, go look it up or call us or go read an article or listen to a podcast or do some research on it before you do it, please. Like, just don't risk it. Don't risk being another case, because most of the stuff that we get is a lot of prohibited transaction. Like half the questions I'm getting, can I do this with my relative? Can I do this with my sister? You know, like more often than not, the answer is no.
Yeah.
So, get those questions like answered and make sure like you're certain before you go and do something, because it's so hard to unwind that once you've already gone down that road.
Yeah. And I think, I have one client that refers people to me, and he sends me a client a week. He's a great client here. And he always refers people over to me. He calls me the self-directed IRA ninja. He's like, here's Matt, he's the self-directed IRA ninja. And then I just get someone on my team involved that can help him. But it doesn't take much to be a self-directed IRA ninja. Like the thing with self-directed IRAs, and if you're a real estate person, like you've mastered real estate, right? Mm-hmm. Now you just got to figure out the IRA piece of it. And a lot of times what you're wanting to do with your IRA doesn't fit how you normally would do a deal. You just got to learn the little IRA quirky rules. And I tell clients it's like learning a new board game. It's not rocket science. You just got to learn it before you play it.
Yeah.
Don't start moving pieces around before you learn how to play the game. There's a rule book for it. It's the self-directed IRA handbook. Okay. Again, it's $20, but like there's tons of resources on our website. There's the podcast. The podcast is basically the audiobook for this thing. It's in a easier to digest way. So, or play with someone like that. When you learned your first board game, you play with someone you knew. It's like, oh, you can't do that. Oh, you got to do this when you do that. Okay, that's kind of how the IRA rules are. Unfortunately, is like you just got to learn those little moves that you got to do, and when to like pass this and you go to jail, or you pass this and you get $200. So you just learn the rules on how it works.
We'll get to how you can set that up and some of the resources to do it. So a lot of people are like, how do I get started? I need to do the LLC. I need to get my IRA. So we'll get to that.
Yeah. Let me show you here, actually. Okay.
We can do it right now.
Yeah. Let me just go here because we're on the website here for directed IRA. And I just want to show you where this stuff is. So if you want to do an IRA LLC, sometimes called a checkbook IRA LLC. Okay. You go here on our website. Now we're going to have a video here. We're going to have the application links on how to, so this is an explainer video here of yours truly. We got the 4 key points on what you need to know. We got the intake form on the LLC and the account app. We got the multi-member IRA LLC we're going to talk about here in a second if you want to partner with people. So a lot of this stuff is there and ready to help just get you educated and up to speed. And then our team is here to help, of course. And there's the law firm at KKOS Lawyers, and people use other law firms. You don't need to use KKOS Lawyers, all right? Like we got other lawyers that send people over here at Directed IRA too that help as well. So, okay. All right, let's go over the multi-member IRA LLC though. Sorry, I feel like I got to get this back to like a decent looking page.
That's cool.
Okay. Now sometimes people come and they're like, all right, Matt, I want to buy a property. It's $300,000. I've only got 200 in my IRA, but my spouse has 100 in theirs. If I combine my 200 and their 100, we can buy a property for 300. Okay, that's possible. All right, or maybe it's like you and a friend or whoever, 2 people that both want to use an IRA to go buy a property. And this could be 3 or 4 or 5. It's the same rules. I'm just keeping it simple with 2. So let's say it's you and your spouse. If your account puts in 200 grand, it's going to own 2/3 of the LLC. Okay, your spouse's account puts in 100. Your spouse's account is going to own 1/3 of the LLC. Now that money goes into the LLC. The LLC is going to have a bank account, as we talked about before. You can be manager. Your spouse can be manager too, or just one of you. It doesn't matter. That LLC then can go out and buy the property for 300. Now, the benefit of this multi-member IRA LLC, of course, is I can combine multiple sources of funds into an LLC to go buy a rental. Now, there's some downsides to this. The first downside, if this is your account and your spouse's account, maybe it's your Roth IRA and your traditional IRA, your HSA and your Roth IRA, or your IRA and your spouse's IRA, or kid's IRA, let's say, those are all disqualified accounts, right? Like that, like you're a disqualified person, your spouse, right? Remember, your IRA can't transact with them.
Yeah.
But you can co-invest. It's like my IRA couldn't buy real estate from my spouse's IRA, right? That's prohibited. But we can co-invest into the same asset. So in a new LLC, we're not buying or selling the LLC between each other. We're taking the initial ownership based on the dollars invested. In this case, 2/3 my IRA, 2/3 spouse IRA, okay? Now, when profits come back, let's say there's 10,000 in the LLC, 6,666 would go to your IRA, 3,334 would go to your spouse's IRA. I was a little generous on the extra dollar to your spouse's IRA. Yeah. For any of you married, you know what I'm talking about.
You did the right thing. You did the right thing.
There's some subtle tips here, you can pick up on.
You know, you're going to get some like personal advice too.
Yeah, this is,
like, man, this is like gold nuggets.
That
here.
tip was worth more than $1.
Whew.
So that was actually my tip. Okay, now again, I could have multiple accounts here, and we've done that with clients where it's like their Roth, their traditional, spouse's Roth, spouse's traditional, their kids' Roths are in there, We got 8 accounts in here at the end of the day, all breaking up the ownership based on the dollars into one LLC to go buy an asset. Okay, now the second downside to that. The first downside was ownership's fixed, you can't change it, okay? And one thing you can't do too, let me say also, is my IRA owns the LLC 100%, and my spouse is going to come over in 6 months and buy into it.
Yeah, I want to do that now.
Yeah, can't do that. Okay. Because now you've got to transfer ownership of the LLC from your IRA to your spouse. That's a transaction. Now you're transacting and buying and selling between each other rather than co-investing into something at the same time. Okay.
How does management of that work? Like, who's manager of that?
Either of you can be manager, or you can both be co-managers. So you still can't take a salary, you can't work on the property, all those restrictions apply. Now, the second downside to this structure, the first is, remember, the ownership restrictions. If it's disqualified people, you can't change it. You got to go in at the same time. We break up the ownership based on dollars invested. Okay. The second downside is this is a partnership. Even if it's spouse's accounts, even if it's your traditional and your Roth, those are 2 legally taxed different parties. So that LLC needs to file a partnership tax return, and that's a 1065 return. And in most states, you'll have to file a state return as well. But basically, it's just like what you tell the IRS, do our form for the state. Now, at the end of the day, if your IRA just bought the property with cash, there's no tax, right? Like, there's no tax. So you're doing the return just basically to tell the IRS that this LLC made money, but then it sends what's called a K-1, which is kind of like a W-2 or 1099 to your IRA, saying, this is how much my IRA made from the LLC. It's called a K-1. If you've been partners in an LLC, you know what we're talking about. But that K-1 base says, here's how much profit this IRA made. Here's how much profit this IRA made. Now, the IRAs take those and do nothing with them because they don't pay tax. So, but you got to file the return. So it's kind of a hassle.
I'm going to give us a bonus third. Can I give a bonus third one?
Okay, yeah.
It's just going into more detail of what you talked about for it being fixed in the structure. So what we get a lot of times, though, is especially when you're bringing in personal funds as another member or another LLC that's owned by you personally coming into that. But that's kind of like active income for you. And you're like, well, yeah, I'm going to bring it in because I got a bunch of money personally or in this LLC or this another business that I'm the member of. Yeah. But I need some of that money out, when it's cooking and I'm getting some profits and I need to like take that out. Well, you can't do that. Yeah. That everybody has to. Yes. Like if one member is doing it, everybody has to do it. So it's a very cool structure, but it has its downside for that. And I get that all the time. And somebody will be like in motion setting it up and they're like, oh, got to press on the brakes. They're like, oh, shoot. We all got to take it.
Yeah.
And that's a big wrench.
Yep. Yeah, good point.
There's your bonus third.
Yeah. Okay. Last thing I had, I was going to make one note on UDFI that I forgot to say.
And then we can do rapid fire Q&A.
Yeah. Then we're ready for rapid fire Q&A. So you tee them up. I'll make my last point here.
Okay. Put them there in the Q&A section, please.
On UDFI, remember when I brought up unrelated debt financed income? That's when they tax the profits that they attribute to the debt. And we went through the example on my great property on, this is on 16th place. I like to call this
all right.
16th place.
Not the avenues, huh?
No.
The place.
Yeah, it's a place.
It's like Park Place on Monopoly.
Yeah.
I'm gonna get Park Place. Like I want the railroad.
Not exactly. This is more like St. James Place. This is more like maybe Baltic Ave.
All right.
Okay. All right.
Hopefully we didn't offend anybody if you're from Indy. Like that could be Park Place for you.
Yeah.
That's cool.
So UDFI, 401ks are exempt from that on leveraged real estate. So my account actually in this example is my self-directed 401k. The 401k plan at our law firm, KKOS Lawyers, which I would put most of my money when I started, I figured out how to self-direct that. It's complicated to do it in a company 401k. Of course, I was determined to do it. And I've had a few clients over the years do it. Very complicated. Yeah. But it's the same deal here for solo K people. You're exempt from UDFI too. IRAs have to pay it though. And I don't think it's the end of the world. We have lots of clients that make great returns in their IRA, but they've leveraged them up to the hill. Also, you can pay off the debt and hold the property for 12 months with no debt, and then you don't pay UDFI on the tax at the end.
Those are some questions. So
yeah.
We just nailed them.
Okay.
Nailed it.
Cool. All right. I know that stuff I need to teach, and you guys called me on it by asking questions. Yeah. Like, why don't you talk about this? Okay. What else you got?
You want to go into the last slide there? Yeah. Let's probably pull up the opening account page so they can see that on there. So let me just go into like getting started. So we put something cool. So if you want to do the IRA LLC structure, awesome. You can get with a law firm and do that, or an attorney. Or if you want to go through KQS Lawyers, you're more than welcome to. Just go do the intake form that Matt just showed you on the site. Now, to get the IRA piece going, you got to open up a self-directed IRA, or maybe you already have one and you want to transfer it over to us. That's cool too. We'd love it. But you can just go to our account opening page there.
Step one here.
So we got to do that. You got to get the account open, and you can do it through DocuSign right now, all electronically. It's super easy. And if you put webinar 50 into section 1 of the application, where it asks if you got a promotion code or a referral, we'll waive the new account setup fee, which is $50. So we'll just go ahead and take care of that, and that'll be great. So it's an easy process. I did get a bunch more questions on the funding. What if I have a TSP account? Yes, that's, it's a tax deferred account. It would be a traditional IRA. You can move the money over there. The other questions I was getting was, what if I have multiple IRA accounts or multiple old employer plans? Absolutely. You're completing individual forms for each account and designating, are you doing a full distribution or a partial distribution out? That's it. So those are the key fundings. Again, that's a rollover, direct rollover, if it's an old employer plan, or if it's a cash transfer, and it's already at an IRA at a brokerage, that'd be a trustee to trustee transfer. You'd use our cash transfer form here. So transfer request cash only, or if you're doing the employer plan rollover, we need a deposit form for that. So you're going to, again, contact them, your old employer, and request that they want to, send a check or wire over to us, but we need to be able to track those funds. So we need you to fill out a deposit form. And if you're doing a 60-day rollover, again, only once per 12 months, then we have that form as well. Do you have a comment or something?
No, I was just say, and then, it's just, we call it 3-step process.
There we go.
Open account, fund an account, invest the account. Now, if you're doing the IRA LLC or the checkbook IRA LLC, we're going to set up the LLC. The IRA is investing in that LLC. We know what that is. We can get the LLC documents all going at the time we're setting up your IRA account and getting your transfer or money funded over here. So that one's a little more simple because we know what it's going to be. Now, the LLC could take a couple weeks depending on the state.
Mm-hmm.
Do you know the name you want to call it? Are you ready to go or not? Or do you need to think about a name and how you want to structure it? Am I doing it by IRA 100%? What state am I buying the property in? You know, we're like, I'm all ready to go. It's XYZ Investments LLC. It's in Arizona. I'm buying a property in Tucson. Go for it. Cool. All right. We will, we'll go get those documents going. Arizona's, on the faster side in terms of states and getting it approved. You're going to be good to go. But if you're like, I don't know the name, I'm doing it in, a state that's terrible in turnaround time, let's say California, you're going to take it's going to take a little longer. So,
okay. So let me hit 2 more items, and this is all Q&A I'm hitting right here. So again, going back to that timeline that Matt was just given on the IRA LLC, the timeline to get your account open, that's done within 24 hours. So if you submit something today, by 5 p.m., we're going to get it done like early afternoon tomorrow. To get the account funded, though, that takes a little bit more time. A lot of it's out of our control.
All of it's out of our control.
So, well, meaning, we can help. We're going to, do some follow-up and be in touch with them, but they'll only talk to us so much. Like, you need to contact them. Even if you're just doing a trustee to trustee transfer, you need to call TD Ameritrade and say, hey, just making sure you got the form that, directed IRA sent over to you. You can do a lot of follow-up to help expedite that process. But typically what we see, if you're, at a brokerage like TD or Fidelity, and you're just doing the trustee to trustee transfer, usually takes about 3 to 5 business days. Sometimes it could take, up to 7 or 8. Now, if you're doing the old employer 401k, that could take a couple weeks. Because that's totally on you. You have to contact them, initiate the process. And here's a little sticky factor. And the reason all this is important, kind of tying this in together, is if you're looking at some debt, if you're actively looking at deal flow right now, and you're wanting to get going, getting a property, you got to get all this set up like now. Like if you got something that you want to make an offer on and you don't have all this stuff open, like you're a week or 2 out from writing offers. So just get it done today. So that old employer plan stuff, though, a lot of times they want to issue a check and
send it to you. It's going to be written out to us.
And then you got to send it to us.
We're going to mail it to you like Money Express. And then you got to mail it here, and then they're going to hold on it because it's going to hold it because it's a check instead of a wire.
Yeah. So get going on it today or tomorrow is what we're saying. There's no way to speed that process up, unfortunately. So that's how that process works. Now, if you're at another IRA custodian, okay, we're totally cool with you bringing it over here. We'd love to welcome you to the family. And you're just going to fill out the form for a new account and just select the account type. And then it's going to be, a trustee to trustee transfer as well. And we're just going to bring it over, and whether you keep that account open or close it out, it's totally up to you. We do that all the time as well. So a lot of people in the industry open an account with unlicensed, unregulated companies that are called third-party administrators, and they are not licensed trust companies, which we're a licensed trust company, and so we get a lot of people moving over to us for that.
Yeah.
Cool. All right, so let's see. Let me hit, mahalo, Arlene. Good to see you. We got a lot of people from all over. She's in Hawaii, obviously. Okay, can I do a lease to own in the name of my IRA and use rent to pay for the lease?
Sure, absolutely.
Is there any advantage of having a Roth over a traditional with SDIRA that purchases rental property?
Well, the Roth to traditional debate is just think of it. If I do Roth today, I don't get tax deductions today. So if you're like, no, I want tax deductions now, or maybe you're in a traditional, you got to convert to Roth, but you got to pay tax today to convert to Roth. But the future is bright with Roth IRAs. It sucks now because you got to pay tax now. Putting money into a Roth, you don't get a deduction. Converting traditional dollars over to Roth, you got to pay tax. So I get it. It sucks today. But the future is awesome because there's no tax on the way out. Now, if you think tax rates are going to go up, that makes the Roth even more valuable. People are all over the map. Even I have Roth accounts and traditional accounts. Okay, it's like I'm mixed on it. I want to be more Roth, but it's painful. So I get it.
Mm-hmm.
So what I would say is the first consideration is just try and get the biggest account as possible. That's the point of retirement accounts, is just get as much in it as you can, whether it's Roth or traditional. If all else being equal, I'd rather have a Roth account because it's totally tax-free on the way out.
Mm-hmm.
Are you okay paying the price and the pain now to get there though? So if you're like, well, Matt, and I have an article on my website is when to convert to Roth. Because I have clients that call me, they're like, Matt, I've got this deal. And in fact, I have probably one a month where someone calls me, a good investor. They're like, I got a deal. It's going to cost me 50 grand, but I can make 400 on it. Like they're going to do like almost a 10, they're going to kill it. They're going to make a great return on it in a short amount of time. It's like, it'll be less than a year. I'm going to turn it. It'll be a huge pop. Should I use my $50,000 traditional IRA or should I convert 50 over to Roth? Convert 50 to Roth, obviously, because you're only paying the conversion on the 50,000 now. When that deal comes back and it has a $400,000 return, let's say, now you look at it and you can say, okay, now I got 400,000 coming out tax-free in Roth. Even if you look at my deal that I had before, like this is one that's actually in a traditional account of mine. I have Roth, but this one that I showed you is in traditional funds. I should have converted this, okay? This was 40 grand, so I would have had to convert, right? The property's worth 170 now. I got about 30 in debt.
Good payday.
Yeah, that would have been a smart conversion because I was converting at a lower value. And it would have been.
But we never know with how much equity is going to increase.
You never know.
So.
I converted other dollars actually, and I've got other stuff.
But that strategy is huge that you shared. So hopefully for those of you, listening, you caught up on,
And we have a whole episode on Roth on the podcast too, on why Roths are cool and how to get there, Roth conversions. We call some of it chunking, just doing pieces of Roth each year. Because if you got some people come in like, I've got a large account, I've been working in corporate America, maxing out my retirement account, or I've been a business owner maxing it out, and now I've got 600 grand or whatever, but I don't want to convert 600,000 to Roth. How can I do 100 or 200 right now, and then just do a little bit as you go?
Okay, so the money that's coming to fund over to your IRA, people are asking, well, where is that going? What financial institution? We're the financial institution. We're a licensed and regulated trust company. So
we're audited by the banking department here in Arizona. We are audited by CPA firms, 2 different ones actually, RSM and Hinton Burdick. So like we're a financial institution. I think that's the one thing when Aaron mentioned like a TPA is they're just an LLC. Like there's companies out there that aren't banks, credit unions, or trust companies handling retirement accounts.
Scary.
And so that's a little scary. There's one of them in Utah.
Not a little, that's clients, a lot scary.
Yeah, they have clients of ours, and I actually had family members there because they're the only provider in Utah that did that back in the day. They lost about 10% of their customers' money, just disappeared. The owner stole it essentially because they were not examined by banking department. There's no way in heck he would have taken that money if they were. They had no CPA audits that could have caught it. And so just be careful on the TPAs. Just work with the banks, the credit unions, or other trust companies. And that's not just to say you need to use us. There's like 20 other companies in our space that are one of those.
Yeah, do your due diligence.
Yeah.
I like this one. Can I chunk a Roth with the property that's owned in my traditional IRA?
Absolutely.
That is cool.
Absolutely. You can chunk that. It's painful because you got an appraisal on the property and you do what's called an in-kind Roth conversion. We can do that. We have clients do that often. So and what I like to do with those clients is I say, can we do it like over 2 years? Let's get one appraisal. On December 31st, 2021, let's convert half. And on January 1st, 2022, let's convert the other half. So at least I got you broken out in 2 years on the conversion, rather than, you got to get an appraisal this year, and then you do an appraisal next year that's a new one, and I got to get an updated appraisal the following year after that. And you got all these different title ownership holding spots. So that's a little tip if you want to try and do it over 2 years at least.
Okay, so we're going to knock out about 6 questions with one answer. And they're all related to the strategy of, do I use one LLC to purchase multiple properties? And then so that's part 1.
Yeah.
And now part 2 is, should I have if I'm in multiple states, do I do multiple LLCs in the different states? And so that's part 2.
Okay, this is really an asset protection question on the front end, the first part. how many properties should I own in one LLC? This is the same answer that we give in my law firm, and I feel like I talk in the past tense. I'm still a lawyer. I run directed IRA too, right? So, but the rule of thumb that we hold, and we think is the best way to approach this is, we're not worried about how many properties you have in an LLC. With your IRA LLC, you could have 10 properties in one LLC. I'm cool with that. Now, if you have 10,000 of equity in each property, there's only 100,000 of equity at risk. But let's say you have 2 properties in an LLC. You bought both of them with cash. Both of them are worth 350 grand each. So between the 2 properties, that LLC has 700,000 of equity. I don't like that. If something goes wrong on property number 1, the tenant slips and falls, they can sue the LLC. LLC's assets are at risk, okay? The limited liability protection of an LLC protects you and your IRA from being sued, right? They can't go after your personal assets or the IRA's other assets, but they can get at whatever the LLC owns. So if the LLC owns 2 properties, something goes wrong on property number 1, they can get a judgment against the LLC and get all the equity in property number 1 and get all the equity in property number 2. Now, we think it makes sense to do separate IRA LLCs based on equity, not on how many properties you have. So if you have multiple properties, we want to do separate LLCs once you have 250,000 of equity or more.
There we go.
So like if it's, again, the 10 properties, they each have 10,000 of equity in it. That's only 100,000 of equity. I'm like, if something goes wrong on property number 7, who cares? There's only 100,000 here that they can go after, and the plaintiff's likely not going to go after that because by the time they sell those and there's expenses to those, there's going to be nothing. On the other hand, the 2 property example there, something goes wrong on property number 1, the plaintiff's going to be like, there's a lot of assets here to go after. I know I can't go down to the IRA or get the IRA owns personal stuff or tax their wages or their personal home, but there's 700,000 here in the LLC. So we'll do a separate LLC, and it could just be the same thing. You have your IRA owns an LLC 100%, that LLC owns a property, then we just have your IRA own another LLC that owns another property, or maybe it's 2 or 3 until you get up to 250K of equity. Now the separate state, you just don't want to hit the
Oh, I do, yes, yeah, okay. Do part 2. Yeah.
So my example was I have the Arizona LLC. Now I did it that way for a couple reasons. One, there's other assets and things I was doing in Arizona with that LLC. But what you can do is, the first thing is we always set up the LLC in the state you're buying the property. So if I was only going to go buy a property in Indiana, I would just do my LLC in Indiana. I do an Indiana LLC, but right out of the gate. Now let's say that let's take my example. Just we'll go through that here. I do an Arizona LLC because I'm buying an Arizona property first, but then I don't want to buy any more in Arizona. I decide I want to go buy a property in Indiana. I can take my Arizona LLC, register it foreign in Indiana. It's still the same LLC, XYZ Investments LLC in Arizona. It's just registered now in Indiana. And so it's the same tax ID, but it's just can do business in multiple states. And you can have it registered in all 50 states if you needed to. So yeah, you can use the same LLC, register it in multiple states if you're buying property in multiple states.
Okay. Ooh. Yeah. So anonymous attendee. I was hoping for a name.
Come on, Peter Lemon Jones.
Come on.
That's a Fletch quote if you don't know.
It's with Chevy Chase.
Yeah.
He's got 750K in a traditional IRA. Would you recommend converting it all to Roth right now and just taking the hit? Well,
I never recommend whether to do something or not. That's just like, we're not financial advisors. So I'm kind of like, do what you want.
But a lot of people are asking this, like, I know you ask it because you're looking for us like, well, what do you recommend? That's why we talked about that chunky method.
Yeah.
You know, so, like strategies. We'll talk strategies.
Here's the thing. If that 750 is going to turn into 1.5 million in the next few years, I would convert it. Like, I'm just saying me. I don't know your situation.
Yeah.
Do you have money to pay the tax right now? Do you have a great deal that 750 can go into next month? Or is it just going to be in the market, or maybe it's doing something at 5% or something that's not going to have accelerated growth? I mean, in the long haul, it might make sense to still convert to Roth, but I'm not like pressed to do it. I'm not going to be like, my personal situation, I'd be like, I'm going to hustle. And I even told you, I have traditional and Roth funds myself. I'm split a little bit. I'm trying to get more to Roth, but it's painful because you got to pay the tax.
Yeah.
So what I would say is just, it depends on what you're doing. If you've got great deals and great returns you can make, I would pay the tax and be done with it. If you're like, I don't know yet, then maybe just convert a little with what you can afford and start doing the chunking thing until you get over to Roth.
Yeah.
So.
Okay.
It's hard. I feel like that's not a great answer. I'm just trying to give you the things to think about because it's like the right answer you need because we don't freaking know. Depends.
Yeah, and we don't know. So Heather, this is a great question because we this get it all the time too. When you have an existing like your current employer plan, or active, whatever you want to say, active or current.
Yeah.
Can you get you're doing the company match, you're maxing out your contribution, totally cool. We do that here. You're like, man, I really want to self-direct. Well, it depends. Usually not. Like they won't let you. You need to contact them and ask them if there's like a portion that you can get, from it. There's a
in-service rollover.
Yeah, in-service rollover. And then if you're over a certain
59
age.
and a half. Yeah. Some plans do it at 55. So if you're
there we go, 55.
Yeah, if you're at retirement age under certain employer plans like a 401k or 403b or whatever, even if you still work there, they have to allow you to roll out. So if you're 60 and you've got a 401k at a company you've built up over, a long period of time, you can roll that money out.
Yeah.
Another one you can roll out is if you had an old 401k and you went to a new job, that old 401k that you rolled into the new 401k at the new job, that old 401k, those dollars can usually get rolled out, even if you're 45, okay? Another one you can get out of 401ks is sometimes a company allows what's called an in-service rollover, where even if you're not retirement age yet, let's say you're 45, you're like, hey, I want to get 50 grand out of this thing to self-direct or 100 grand. There is a ways that they let you take your employee contributions out. Many plans allow that. It's called an in-service rollover, meaning you're still working there and in service of the company, but they do allow a portion of the funds to get rolled out. So it's worth looking into. I've had clients, it's hit and miss on whether they're allowed to when they're under retirement plan age, but those are the ones I've seen get out. In-service rollover, and it's usually with the employee contributions actually, which is a little odd that you get those out. The old one, or the other one is you had a prior employer 401k or maybe another IRA that you rolled into the new company 401k where you're still employed. A lot of times you can get that money
out. We'll just do a couple more. I mean, we have some of our team on, so thanks Gordon and a few other people. I don't know who else hopped on, but he answered like over 50 questions. I was like, send you some good ones though. So, but yeah, we
got a smart team here.
Yeah, we got it. Yeah, a great team going over it. So, okay. Buying rental property overseas. Can I do that?
Yes. So foreign property, though, you're going to need to use the IRA LLC structure because we won't hold title to a foreign asset because we got to register in your foreign country and all that. We're not going to do that. So we'll allow your IRA to own an LLC 100% in the U.S. So let's say you live in Florida. That's the last one I had a client buy a property in Belize. Their IRA owned a Florida LLC, 100%. That Florida LLC went and set up an IBC. Basically, it's a company down for that area, and that entity ended up owning the real estate in Belize. So it takes a couple steps. The one thing I'll say is the foreign country's recognition of this being an IRA and not being subject to tax is not likely. So make sure you're realizing that and getting your own tax counsel and legal counsel in the foreign country you're buying the property at. But to use the money here in the U.S., you'll still get the no tax treatment in the U.S. on it, even though the property's owned in, let's say, Belize, or it's in Mexico, or it's in Spain, or wherever. Those are just ones I've had. That's okay. But I don't know what Belize and Mexico and Spain are going to tax you on.
Yeah.
So use the LLC though, because that's the mechanism to execute it.
So if I purchase rental property and then later I want to enter into like a lease to own type deal with the tenant, can I do that?
So the IRA owns it and it leases it to the tenant with an option for the tenant to buy or they're lease them. Yeah, that's totally cool. Absolutely.
That's a great strategy actually too. Yeah. Like you could, you then become a little bit more passive too. Even.
Yeah, you get better tenants. You get.
Yeah. I'm not quite sure on this one, but we'll see if we can get it. Maybe Matt knows there's some tax strategy here. How long do I need to own the rental property with my IRA before I can sell it and then start doing my 2 flips per year? You must be talking about like the active to get around UBIT. That's what I'm assuming.
Yeah. So there's a tax on flips. Now for rentals, I didn't bring this up because that's what we're trying to say is rentals. There is a tax if you're flipping too many properties in an IRA, meaning a flip meaning it's something I buy and sell under 12 months. So I buy it in May and I sell it in August. Okay, that's less than 12 months. The IRS is going to look at that and consider it a flip for purposes or really short-term capital gain. Okay, that's the tax fee for it.
Okay.
So what happens is there's another tax. There's UDFI, which remember deals with debt. There's another tax that applies to flips or people that flip properties or real estate developers. That tax is called UBIT, unrelated business income tax. And actually UDFI is a piece of UBIT or UBTI, but just think of UBIT as I'm flipping properties or I'm doing real estate development. IRAs are designed to receive investment income, rental income, capital gain income, interest income. That's all cool for IRAs to receive. They don't pay tax. But if your IRA is deemed to be in the business of something, like flipping real estate, which would be a business and not investment activity, or doing a real estate development, that's considered a business activity and is subject to UBIT, which is unrelated business income tax. It's a 37% tax on income in your IRA. Woo! So you want to avoid it. So what was the name of who asked that question? So that question was asking basically, I know I can only do a couple flips a year with my IRA. Rental, does this count against me? No. If you own the rental for over a year and sold it, that's not a flip. What we tell clients in general is you can flip 1 or 2 properties a year in your IRA and you're not going to run into UBIT. Even though they're short-term deals, the IRS can't really say you're in the business of real estate, or sorry, that your IRA is in the business of real estate because it only did 2 deals.
Yeah. If
it did 3 or 4 flips in a year, in this 12-month period, these are properties that close in the tax year that were held for 12 months or less. If your IRA has done that, and it's got 3 or 4, you're kind of in a gray area. If you did 5 or more in the tax year that are all short-term flips, you're going to have UBIT. There's no way around it, okay? You've done too much. The IRS is going to say, your IRA is in the business of real estate. Look how many deals you did this year that are all short-term. But you could have 100 rentals that you own in a year, and you sell a few here and there, and that's cool. Those are owned over a year, so they don't get calculated into the 2 properties a year.
That was our friend Joel. Thanks, Joel.
Okay. All right.
Let's see. Can I change my IRA LLC to a series LLC later, assuming that my state allows it?
Yes, absolutely. So we can amend your IRA LLC, the law firm, I should say, KKO Search can amend that to a series IRA LLC. And we set up series IRA LLCs right out of the gate too, if you know you're going to have a lot of properties in there.
We'll just answer it. So Karen came in a little late, mentioned, yes, you can do crypto with us, or you can do it with the IRA LLC structure. You can do it direct with our relationship with Gemini. Can you also do gold and silver? Yes. We have some articles on that. We don't have vendors or providers that we recommend. You would need to have that, but your IRA can most definitely purchase that. Mm-hmm. Yeah. Okay, Wayne, this is good for those of that are approaching RMD. He's actually 71. So I'm 71 and would like to use IRA to purchase property. Can I take the rent payments, for income, and what are my tax implications on that?
Okay, yeah. So if you're in your 70s, or even late 60s, one thing with anybody with traditional accounts is you have the required minimum distribution rules. Roth IRAs don't have RMD. Roth 401ks actually do. So on traditional IRAs, did he say he had traditional?
I'm assuming it is. He didn't say, but let's assume it's traditional.
Once you hit age 72, and it used to be 70 and a half, but the rule is now 72, you have to start taking money out of your IRA. It's called RMD. Let's say you had a $100,000 account. You basically have to take like 3 to 4% out a year when you hit 72. So you got to take, let's say, $3,000 out on a $100,000 account. You got a $200,000 account, you're going to have to take 6 out a year. Okay, the IRS is forcing you to start pulling money out of this because you got to start paying taxes on it. Like, all right, enough with all this tax deferral. We haven't had you pay tax on this. Start taking the money out a little bit. We're going to make you do it so you can send us some tax. So what I would say is that's a great strategy. Have the IRA buy it. Just make sure that the cash flow and the rental income you're getting is enough to satisfy your RMD. So if you're getting 10 grand a month or more, and like, again, you got the $100,000 account or even $200,000 account, that's going to be enough to cover your RMD for the year. And you can just take the distributions, like the rent's going to get paid to your IRA. Then you just take the distribution from your IRA. You can live off that cash flow. and it'll also satisfy R&D.
Love it.
So you want to look at it though. If you're like, I got $1 million account, okay, taking 10,000 a year is not going to cut it.
Well, this is a good one. Thanks, Bob, for asking, because this is a good one. You follow the advice. When in doubt, let's ask a question. So IRA LLC, purchasing real estate. He also develops software. Can I do that with my LLC and have the LLC be paid for the services?
Definitely not. Yeah, yeah, you want to keep anything you're personally doing separate, and your IRA LLC couldn't be doing that and you're doing the work for it. That would violate the rules. Now, there are ways you could use your IRA to own a company and a business that is paying other people to do software development. I've had clients do that. But you can't be the one doing the work in that IRA. Your IRA owns the LLC 100% context.
Okay, Sherry, I like yours. I want to focus on short-term rentals. This is about me needing income. Should I plan to buy a few properties in my self-directed IRA? I believe I should. Okay, great. You should. And a few others should be bought via my personal LLC and use that money for income now. Yeah, sure. Yeah, because really what you're talking about there, just if I'm reading the context correctly, if you're going to try and do like the multi-member IRA LLC, you can't go get that for active income unless your IRA is doing it too. So if that's what you need, then do it separate. Okay, so Bill, I think.
And let me say this too.
Go ahead. Yeah.
I will just say this. This will be my last point. We may do one or two more questions.
We'll do two more.
Okay. When we're talking about buying a rental in your IRA, I'm not saying buy a rental in your IRA and don't buy rentals in your personal name. Even me, like I own rentals personally. My IRA, my retirement account owns rentals. Okay, I'm not saying it's do this instead of buying rentals in your personal name. I'm just saying if you're good at real estate and that's what you know, it's a very popular asset, obviously. There's lots of stuff out there and opportunity. So why not invest in what you know and do it personally and do it in your retirement account? So we're not advocating don't do it personally. I mean, I'm just saying, think of it in terms of investing in what you know more.
Let's see. Okay, two more. Okay, I think I'm following this. Bill asks, what if I buy property from a wholesaler who has the contract in a different name and you buy with an assignment?
That's cool. Totally fine. As long as you're not the wholesaler.
Yeah.
Or your company that you own personally is not the wholesaler.
Yeah.
Absolutely fine to buy it and get it assigned.
We didn't really talk about this, but we can kind of make this point. We'll do one more question, and we should just make a comment on a step transaction.
Yeah.
You know, it would be an added bonus round. So you want to hit that?
Yeah. So there's something called a step transaction. So what some people will do is, let's say your dad owns real estate. You're like, oh, my dad's got a property he wants to sell. I want my IRA to buy that, you know? But I know my IRA can't buy from my dad because my dad's disqualified. My IRA can't transact with my parents, can't transact with me or my spouse, right? So say, well, why don't I have my dad sell it to my brother? And then I'll buy the property from my brother. Well, that doesn't work, okay? That's what the IRS calls a step transaction. I get it, you're getting around the rule. Your brother's not disqualified. Your IRA can transact with your brother. But you can't arrange a transaction to get around the rules like that by putting a straw person, your brother, in this example, in the middle. The IRS will treat that, and so will the tax court, and I think it's fair, as if you just bought the property from your dad and violated the rules. So don't try to put a straw person in the middle to try and get around the rules. That never works. In fact, it makes you look more guilty. Okay, yeah. It's like
you knew what you were doing.
Exactly. You knew you were doing this wrong, and you did it. And not only that, you tried to conceal it. It's kind of like, you know, I think it's like a Law and Order episode where like you get caught, but there's no gun or no evidence. Yeah. But they think you did it, but they're like, I don't know, there's a really criminal intent here. And then instead you've got, oh no, he's holding the gun. It's got his prints on it, and there just happens to be blood on it too from the victim.
Glove doesn't fit. Too soon. Okay, well, let's wrap up with this one. I like this one. So Bill asked, did the non-recourse lenders refi? Can you do a refi with a non-recourse lender if your appreciation grows? Pull the money out. Of course, it's got to go back into the IRA and then invest with those funds again.
Yes, I know Solera does that. And
Awesome.
First Western Federal does it. I've seen it on theirs. So yeah, that's possible. Even some people just refi to a lower rate. Rates have gone down since when they did their non-recourse loan to begin with. And they just got a better rate.
We're going to end on a high note.
Yeah.
That was a good one. So thanks everyone for being on here. Got a lot of great comments, got through almost 100 questions and, several hundred people on. So that was awesome. So got a couple people thanking us for doing this, and gosh, we did 1 hour and 45, huh?
I know. Did we schedule this for an hour?
I think we just put the start time.
Okay.
And not an hour. I feel like we do
These are usually an hour, but maybe they do go an hour and a half. But
so far, all our webinars are really long, and it's like a long Joe Rogan podcast or something. It's like, man, strap in for the next 3.5 hours. Yeah. Like we're gonna do like a mini summit this afternoon.
Yeah.
So
well.
All right.
Yeah. Thanks, Aaron, of course, for all your comments, and everybody appreciate your questions. We'll get the slides that'll be up on the webinars page at directedira.com, which should be up tomorrow.
Yeah, we'll drop y'all an email too, following up. So
you're gonna follow up email letting you know when it's posted. Please get out there and share it. Let us know if we can help. Be your self-directed custodian at Directed IRA. If we already are, thanks for your business, of course.
Awesome.
And we'll be back next month. We do not have the topic yet, but make sure you're subscribed to the newsletter, which you can get at directedira.com, where we announce our upcoming webinars there. So we'll see you next month.
Signing off.